Inflation numbers came out in the U.S. today. Headline CPI jumped to 4.2% year over year, up from 3.8% the last month. This is the hottest reading since April 2023. Energy alone drove over 60% of the monthly gain, but core CPI is now only at 2.9%. Core goods actually fell. So the inflation is narrow, not broad. Gasoline is up 40%, fuel is up 58%, and airfare is up 27%. Notably, it's not shelter this time, and the big decliners, motor vehicle insurance, biggest drop, new vehicles, prescription drugs, and dairy. Is this setting up to be a 1970s-style energy shock that's going to have a ripple effect on the rest of the economy? We'll find out with the next guest, Lobo Tiggre, founder of the Independent Speculator. Also on the agenda, what Lobo thinks is going to happen next to precious metals and what he believes are the best commodity plays right now. Lobo, welcome back to the show. Good to see you.
Always good to talk with you, David.
The inflation numbers, let's start with that. And I just looked at the calendar. I told you offline, I haven't had you on in months. So we want to revisit your last call when you were on the show with me late last year. And then let's talk about this roller coaster ride that gold and silver, as well as some of the other metals, have seen since the beginning of the year. This is a visual of the breakdown of the CPI index that came out today. Fuel up the most, and shelter up 3.4% only, food up 3.1%. Core, like I mentioned, is up 2.9%, still higher than the Fed's 2% target, but not as high as the headline CPI that includes food and energy. Medical care goods, used cars and trucks, motor vehicles, I mentioned, all down. So the when the Fed looks at this data, and they don't look at CPI, they look at PCE, but it's going to be a similar story, I'm sure. When the Fed looks at inflation data, do you think they're going to strip out energy and say, look, it's not core, it's not what we look at, we only look at core, and so this is a temporary shock? Or do you think that they're going to be looking at this and saying, well, energy has gone up, it's gone up several months in a row now, and we know that energy is the biggest contributor to the CPI rising, but energy will have a ripple effect on the other portions of the economy and bring up the overall CPI index. So we need to pay attention to this. What do you think is going to be Kevin Warsh's message next week?
Well, multiple threads to pull on there, David.
Yeah.
First off, the Fed has already told us multiple times that they look at core PCE as their preferred mismeasure of inflation. So, I mean, that answers your question. They're telling you what they're focused on. That said, it's funny how these things happen. Core CPI comes out, it goes up 2.9. It went up, and everybody's all happy because it wasn't as bad as feared, or it went up as expected. Well, who cares whether it's up as expected? It's up. It's going the wrong way. And another thread that you put in there is, yes, there's obviously a push to look through this. It's the war, it's one off, it's transitory, mm-hmm. Right? But whether it's transitory or not, it's higher prices, and that's going to piss off people who vote. But B, the uptick, or rather the bottom, was before the war. So both CPI and PCE already started to rebound before the war, and they're just going higher. So I don't think, I don't think it holds any water to say, oh, it's just transitory. Oh, it's just war. It's not in accordance with the facts. And even if it were so, it still matters. It's still higher prices. And, we never really see deflation undo the increases. You just see the rate of increase slow down again, and everybody pats themselves on the back for beating inflation, whereas the consumer out there is still struggling with prices that haven't gone up. So, we can look at our crystal ball or magic 8-ball about what Warsh is going to do, and all the show about independence and all that. It's nonsense. We saw what happened with the last Fed chair. We know why this one was picked. So it is reasonable to expect a bias towards easy money, whether the circumstances merit it or not. I mean, objectively, right now, Warsh is in a real hard spot because everything is screaming higher inflation. And yet, he's sort of put in there to cut rates. So it'll be quite interesting. As we speak, we are coming up to, we're a week on the next Fed decision. It'll be quite interesting to see what we get. There's a bit of a honeymoon period here. I don't know that the markets will overly react to the Fed doing anything. I think there's a pretty good chance they won't do anything, and people might in the White House might even forgive that first meeting.
Yeah.
But the language around it, that'll be quite interesting. I think we should expect quite different language around it under Warsh than under Powell.
Right.
And that'll tell us about where things will head, I think.
So the markets are currently anticipating hikes by the end of the year, no cuts. I suppose if Kevin Warsh surprises us on the dovish side, that's bullish for all assets, correct?
Well, prices, but it's a double-edged sword. If he surprises, well, remember, it's just him. He's one of 12 votes.
Yeah.
And even without Powell staying on, we already saw more division in the Fed before Powell stepped down. So it's simply not true that Warsh can make the Fed do whatever he wants. We'll find out just how much he can push that. But if the Fed did actually cut next week or indicate that it's leaning towards cutting anyway, regardless of the data, I think that could potentially make things worse. The market will say, oh, what does the Fed know that we don't? What are they signaling here? There's something really bad if despite all this inflationary data, they're talking about cutting. So, it's that rock at a hard space is, really hard to get out of. I almost don't know why he wanted the job.
It's yeah. Maybe his family connections had something to do with it. Who knows? The TIP ETF, which is a measure of inflation expectations, has interestingly dropped like a rock since the beginning of the month, despite the war being ongoing and despite higher gasoline prices being an ongoing concern. I wonder why that is. I know, nobody knows for sure, but can you offer an explanation as to why? That doesn't make a lot of sense to me, but.
Yeah, no, I'm not a bond king, so I'm probably going to defer on this and just point you at the other market data that you already mentioned. The market is telling us that they expect no cuts, and the odds of a hike in not this meeting but the next one are substantial, just under 50% last I looked. And the odds of hikes in the following meeting, like not the next one but the one after the next, right? They're majority odds. And if you look all the way in December, the odds are quite a small minority that rates will be anywhere near where they are now. We're looking at 2 or 3, and there's even a smidgen of odds of a fourth rate cut by the end of hike by the end of this year. Excuse me.
Bless you.
So the market is telling us that the Fed is going to hike. Now, if the market is wrong, or if the Fed cuts despite what the market's expectations, that has the recipe for some interesting fireworks.
After interviewing investors, economists, and fund managers and countless analysts for years, I've noticed something. A lot of people watching my show understand the case for gold. They understand the concerns around government debt and persistent deficits and what's happening with currencies around the world. They've heard all the arguments and all the narratives, but understanding something and acting on it are two very different things. That's where many people get stuck. They keep researching, they keep waiting for the perfect moment, and they tell themselves they'll look into it later. Then years go by. So what we're seeing now is more people deciding to take action, which for some people means purchasing physical gold directly, and for others it means moving a portion of an IRA or a 401k into a gold IRA. That's one reason I partnered with Augusta Precious Metals. What I appreciate about Augusta is their educational approach. They take the time to explain how everything works, answer your questions, and help you evaluate whether precious metals make sense for your specific goals and circumstances. They're not here to make the decision for you. They're there to help you understand your options. No pressure, no hard sell, just information. If you'd like to learn more, visit the website in the link down below or scan the QR code here, lintrustgold.com, or text LIN, L-I-N, to 35052 to receive Augusta's free information guide. Yeah. You had called, let's move on to some commodities and how markets are going to respond to the Fed. Now, my concern is that we're going to get a sell-off of all asset classes like we had in 2022 if we have persistent rate hikes. Now, I don't know if they will hike at all, and if they do, it's going to be a one and done. Nobody knows for sure. Do you see a 2022 style horizon or set up on the horizon,
Yeah,
Lobo?
yeah. So it's interesting because I mean, we've got two hot wars in the world going on right now,
That's
either
right.
of which could literally take us into science fiction movie scenarios. We don't need to go down that path, but the reality is these things are still going on. Um, and we also have an administration in the United States that agree with them or disagree with them. They are trying to make big changes, and that always is disruptive. So, and when you've got a balloon floating in a room full of pins, and you get a large new source of pins coming from a very powerful, location in the White House, there's lots of reasons to expect major disruptions. I don't want to predict the crash of 26,
Hmm.
but the ingredients are certainly there for something to blow up in a big way and cause a big reversal. But to your question, this is interesting. So, like, the ingredients are there for something really big happening. But even if nothing, it doesn't blow up, it's not a giant crash, just the dynamics of the Fed not giving the market what it wants and craves could cause, as you say, a 22 style drawdown. Not a huge, not a 2020 flash crash, not a 2008, but just a 22 would be quite significant all by itself. And that has knock-on effects for other things. A third sort of pathway here is, let's say we don't have any of the wars make some big blow up, but if you get a 22 style correction in a market that has all this AI hype going on, I mean, multi-trillion, $1 trillion IPOs in multiple companies, nothing frothy here, nothing to worry about here. No
Yeah.
signs of irrational exuberance in this market, right? In that context, what happens if you get a normal market correction in that abnormally exuberant market? That alone could actually trigger a cascade effect that could take things much lower.
Speak.
Sorry, just real
Yes.
quick. So again,
Yeah,
I
please.
don't want to say, I don't want the headline to be, Lobo predicts crash of
No.
26. But there are so many pins around these balloons or bubbles out there. I think it is reasonable and prudent to be rigged for quite stormy weather. And by that, I mean hold a lot of cash, which is what I'm doing right now.
It's interesting you say hold a lot of cash, not a lot of gold. Let's turn now to gold. You had got to be called on my show late December when you were on copper to be a top performing asset, and to a certain extent it has. Copper has reached new all-time highs, has diverged from gold. We'll talk about copper in more detail in just a minute, but let's talk about gold first. So since you're on the show, gold has climbed to a new unprecedented level and then fell to pretty much the same level you and I spoke about since you were on the show in December. So basically, it's gone up in a roller coaster, up and down since you were on the show late last year. Same exact level as it was in December 2025, actually a little bit lower. Now, this is interesting because if you take a look at some sentiment indicators, which I'll show you in just a bit, gold is really out of favor right now. According to this particular chart, BPGDM Gold Miners Bullish Percent Index, it's at a multi-year low. Now, I'm about to flip over to my screen now and show you COMEX Open Interest, which some people use as another gauge. Take a look at my screen now, Lobo. This you can see here. This screen here. You can see open interest on the COMEX in negative territory. And yet, if you look at gold, yes, it's fallen from 5,400 down to 4,200 and change, but it's still a lot higher than it was exactly 12 months ago, much higher than it was 2 years ago, much higher than it was 3 years ago. I wonder why the bullish such a bearish sentiment now, Lobo.
Well, as a market watcher, David, direction of change matters.
Yeah.
And clearly in today's market, valuations have taken the back seat. So as you're sort of alluding to with your question, the fact that gold's gone down to, as we speak, 41 and change, closer to 4,000 than it's been quite some time. If you've got mines that were built assuming sub $2,000 gold prices, you're still printing cash. The fundamentals here, the reality on the ground is extremely bullish for the actual business of mining the stuff, building mines, and exploring for the stuff. But markets respond to they're forward looking, and so they look at the direction of change. So while margins were expanding, it was happy, happy, joy, joy, and the stocks were zooming. Now margins are compressing. And even though they're still great, they're compressing from, like a super high level to just a terrifically high level. The direction of change has reversed. So it's not surprising to any longtime market observer to see sentiment sour. This is actually not bad news in the sense that the way a disciplined speculator, not a wild gambler, the way a disciplined speculator makes money, what Doug Casey taught me, and what I'm sure you've heard Rick Rule say many times, is when price and value diverge, there's opportunity. And it can be either way, by the way. If they diverge one way, you go long, they diverge the other way, you go short. But if we have the value of the companies tanking on the markets while the price of the company tanking on the markets while the value is actually higher than it was a year ago, much higher than it was 2 years ago, and so on. So let's say the objective value of a company, a producer, and you put the margins in your model and so on. Let's say the value is the same as it was 18 months ago, but the share price due to sentiment is lower than it was 18 months ago. That divergence is an opportunity. And I want to be very careful about this because I'm not suggesting that it's safe to buy now. I'm saying there's a value proposition, and if you can hold on through the volatility, there's already an opportunity there. But the trends are still downward, and I'm not sure that the selling is done. Now, I'm not saying that I can time the market. I'm not telling anybody I can bottom tick this thing. But I can't say that I feel in a hurry to rush out and buy now while things are still visibly in falling mode. I will want some evidence that the safe has hit the pavement and I can pick up the pieces that are there. Not sure where you want to go from there, David, but let me just point out one other thing. That first chart you brought up, just the gold chart, that peak, that screaming peak, the sharp, and then the dead cat bounce, and the shape of that following it, it looks a lot like 2011. If you superimpose that chart with the same chart for 2011, there are great similarities in the bumps there. And there are even similarities in the 1980 peak. And people have gotten mad at me for pointing this out. Darth Silver has turned into Darth Gold. I'm bullish. I'm a fundamentalist, but I'm not going to ignore the data. And if January looks an awful lot like the two last major peaks in gold, it is reasonable to at least consider the possibility that we might have an interim top, not all-time top, right? And that's another reason to be cautious. That's another reason why I'm holding on to cash. I follow the very basic idea of buy low, sell high. I bought a lot of gold and silver stocks over the years, and when they went screaming up in January, I took some profits. I took a lot of profits, David, and I have right now a very large war chest, more than I've ever had. I'm about 80% in cash right now. That's not a goal. It's not a number I recommend to everybody. I'm just saying I had so many unrealized gains that when I took them, it just really cashed me up. And the good news about this is, I don't know what's going to happen next. I'm not promising anything here. All I'm saying is wherever the next opportunity is, it might be in gold and silver if they overcorrect. More likely, I think we'll see it in oil or copper, depending on how the war goes. And quite as surely, I think there's money to be made in the uranium space. So I'm cashed up and I'm ready to deploy wherever the market presents me with the opportunity. I don't have to predict which, opportunity that will be. All I need to do is hold the cash for whenever it presents itself.
The key point that you've made is that this is similar to 2011. I've made that point on my show several times already. I agree with you. That's what it looks like. Let's just revisit gold's prior bull cycle history here, now that we have a long-term chart of gold on the screen. 1980, 2011. I'm going to count 2021 as a top as well, as a local bull cycle, and then we can have a renewed bull cycle from 2023 to today. Now,
sorry, let me jump in, David. If you count
please.
2020, 21 there, if that's a cup and handle, like the handle has gone way beyond expectation. That's not
You're
bullish.
Right. Okay. So
are you going to count? Analyst, but I'm looking at that. That's crazy.
Maybe we should start counting from 2019 to now then. Maybe that's a more fair comparison relative to prior secular multi-year bull cycles. It just scares me if we do that, because if you take a look at what happened in 1980, it peaked, and then the trough was 70% down from the peak. Same thing happened in 2011. It peaked around $1,900 and now it's in a trough. A couple years later, down 45%. This is a very cyclical market, and they've fallen double digits percentage-wise. The gold rather has fallen double digits percentage-wise in the prior bull cycles. And if I'm looking at this and I think to myself, history rhymes but doesn't repeat, even then, I would be scared to get in right now, given that it's gone down 50% of the past.
Yelling at me, isn't it cheap enough? Hasn't things sold off? No, off of recent highs is not the same thing as a buy low type opportunity. And you're exactly right. We're looking at, on the last major peaks, let's call it a roughly average of 50% drawdowns, kind of like Bitcoin.
Yeah.
Right. So if that's the average, it is not unreasonable to say, if I'm not saying that January of 2026 was September of 2011 all over again. I'm saying if it was, a 50% drawdown would be reasonable to expect. If that's so, we're looking at sub $3,000 gold. So when people are saying, oh, gee, gold's down from 55, 5,600 to 4,000, aren't you ready to buy yet? My thinking is, I don't know the future, but if that's true, the no-brainer level would be sub 3,000. At that point, I wouldn't care, what happens, what's going on anywhere else. That would be a level at which I would consider it stupid cheap, with mining costs where they are and the demand and the central bank buying and, all the fundamentals out there in the world. If gold drops that much, I think that becomes an absolute no-brainer.
A couple of events I want to draw your attention to this year, because I haven't spoken to you since January, late December. Now, I remember when $3,000 gold was just hit, and people were talking about $3,000 gold all the way back when it was still at 2,000, and they say someday very soon it'll hit 3,000. Those people ended up being right, but every single person that I've talked to about that, it reached its target before their anticipated timeline, and so the momentum was very fast. What was your initial reaction between January 2026 and late January this year, when it went up 30% all the way up to $5,500? When it hit above $5,000 for the first time, which was a mythical target that people have been talking about for years and years and years, yes. What was your first reaction?
That's exactly right. When we talked about, years ago, if you would say, well, look, there'd be this crazy world in the future with war in the Middle East, big changes and money printing gone mad, gold will hit $5,000. That was the target. Well, we hit it. One more thing that you didn't mention, but there was the Venezuela thing, and then Trump signaling that Iran was next. So in that run up in January of this year, it's not like gold just did it for no reason or with no impulse out there. How could the gold market know what was going to happen with Iran and that the Strait of Hormuz was going to be closed? Well, obviously gold doesn't know anything. It's a lump of metal. But market participants were getting the signals from the White House that there was something big coming. And so that run up is not surprising. Your question is, what was my reaction? My reaction is, gee, we hit 5,000. That was sort of like a dream price. I got to take some profits here. And then when I started thinking about, okay, now what kind of profits do I want to take? Well, I looked at what I had in my portfolio, and there were a lot of huge unrealized gains. And I thought, you know what? The market is signaling. I'm getting all my price triggers are rolling over. Market is telling me that's changed. I'm gonna not just take some profits. I'm gonna book my wins. And I'm also going to clean out my portfolio of any stocks that I'm worried about. The market's rolled over, so I'm going to book my wins. I'm going to get and cut the risk. And that ended up with me basically selling all of my gold and silver stocks. The net result of that, people say, oh, you fool, you made this mistake. Well, $1,500 lower. I'm not feeling very foolish, David, for having sold. I'm not claiming to have top ticked the market with my selling. I will say, this is for the record, you can go look at Vancouver Resource Investment Conference recordings. And I talked about taking profits and rotating out of gold and silver into other, buy low opportunities coming up, like 2 or 3 days before the January peak. So that was my reaction. There is documented evidence to answer your question that my reaction was like, wow, this is way faster, way higher than I expected. This is payday. I'm going to take my paycheck.
Was it the level that made you take profits, or was it the momentum and the speed at which it climbed that made you take profits?
Well, actually, I think you and I have talked about this before. I don't claim to be smart enough to time market tops or bottoms.
Sure.
I have something that I call the upside maximizer. It's a mathematical strategy for setting triggers for taking profits. And I had long said that, look, I don't know when the market's going to top. If one company gets triggered on one of my upside maximizers, that's idiosyncratic to the company. If I start getting triggered across the board in my portfolio, that's the market telling me something has changed. And so that's what happened. All my upside maximizers, boom, 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 started getting triggered. And I said, hey, the market's changed. That's what made me inclined to not just, as I say, take profits, but go ahead and cash in. And that's why I'm loaded for bear now. Like, we say loaded for bear in the US. That means you have your big caliber gun in case a bear runs into you in the woods. But I'm loaded for bear market with big caliber dollars now, waiting for redeployment into the next opportunity to buy low.
Gold has been traditionally known as being a stable asset. So a move like late January, where it went down 18% in a span of 48 hours, is really not normal. Now, when you see a move like that, which happens once every, I don't know, decade and a half or so, the response from you is what, Lobo? Do you think that this is a great buying opportunity, or do you think that all the smart money is dumping now and this is the end of the bull run?
So actually, it's not that abnormal. As we were just discussing, that same pattern is very similar to the peak in 2011
Mm.
and the dead cat bounce that follows. So, right before that peak was when I was talking in Vancouver about rotating out. Then that waterfall happened, triggered all my upside maximizers that we were just talking about.
Hmm.
I didn't sell on that waterfall. I waited for the dead cat bounce,
Yeah.
and that's when I sold. And then people told me you're an idiot. And then the next waterfall happened. So, I mean, to me, this actually looks pretty familiar. This looks like what you expect after a major reversal. And let me push back on one other thing. I
Sure.
don't think that, the price of gold, or the gold dollar exchange rate, as I call it, it's not that stable on a short-term basis. If
Mm.
we've talked about this before, if you chart gold versus the United States dollar's purchasing power since the two were severed in 1971, it's a giant X-shaped chart. Like, over the decades,
Yeah.
that makes perfect sense. Money printing, the values of any of the currencies go down. Anything real, whether it's gold or real estate or whatever, is going to go up in any fiat currency over time. Like that I think is an undeniable reality. And that's the kind of stability that people talk about when they refer to gold as a safe haven. Not what happens on any big market fluctuation. I mean, just for example, we all know that in a major waterfall event like 2020 or 2008, everything gets whacked, even gold, even like physical gold, never mind the gold stocks, because of the liquidity squeeze. And that's not gold failing. That volatility, it doesn't mean that gold is somehow not a safe haven asset. That's a result of people selling their gold because they have to. They're getting margin calls and they're dipping into their savings account, their insurance policy, exactly for why it's there. So all of this to me seems par for the course. And I'm not saying that gold has to go down sub 3,000. I'm saying that if it does, I'll be buying with both hands. If it doesn't, then there's probably something else that will offer me a chance to buy low, and that's where I'll plan to deploy mostly.
If gold stays around 4,000, I'm not saying it will. Let's just say it stays around 4,000 for the remainder of this year into December 2026. Is that a bullish signal to you? Is that confirmation that it's bottomed out and it's finding consolidation?
Yes. Again, I'm not a TA, but
Yeah,
if our historical comparisons are 2011 and 1980,
right.
the slide kept going. Like, it just kept getting worse. Sure, there were more dead cat bounces or
Hmm.
bumps along the way, but basically it was a downward trajectory for the next year or two or three after that.
Yeah.
So this time, if it consolidates at around 4,000 and doesn't continue downwards, that will be materially different from the last two peaks, and that will make me much more confident that this isn't 1980 or 2011, but it's actually just another period of correction and consolidation before the next big leg, which I would expect to be up. That is actually still my base case, is a period of correction and consolidation before the next big leg up. But
Okay.
a period, sorry, just real quick, a period of correction and consolidation doesn't make me in a hurry to buy now,
Yeah.
right? I want to focus on an opportunity to buy low. The, to buy high and hope to sell higher, that might work. But if I want to add a zero to my net worth, I need to find something that's legitimately an opportunity to buy low. And $4,000 gold and $65 silver, that's not low on a historical basis, even adjusted for inflation.
I final question on gold, and I want to move on to other commodities. The narrative that gold is for war. I've heard this a lot. That narrative has quieted down ever since gold went down, since the Iran war broke out, and then the narrative then shifted to, well, gold predicted the Iran war, it sniffed it out, and that's why it went up before. I don't know what to believe anymore.
Well, I did say that, right? Trump
Yeah,
was signaling, he was saber rattling about Iran before the Iran war. And, we mentioned, how could gold know that the Strait of Hormuz would be closed? Well, if you're going to go to war with Iran, that's a pretty logical knock on effect. But I think there's more to it than that. Well, one, remember the giant X over the last 70 years, right? When you talk about gold being a safe haven, that's what you need to keep in mind, not the
sure.
wiggles in the short term. As far as gold in war, there's a lot of, I think Schadenfreude people jumping on the pile up here, kick them while they're down. But I think they're quite wrong. It's not that gold is somehow failing to respond as a safe haven should in war. If anything, the fact that sovereigns, Turkey and Russia, and we don't know how much the Middle Eastern sovereigns have been selling, but the fact that gold has actually held up this well in the face of massive sovereign selling is pretty bullish. I mean, the argument here is really interesting. And in fact,
Mm-hmm.
after the dip a couple months ago, the latest numbers show that the net change in sovereign holdings, central bank gold holdings, is up again. So I think it's quite interesting that it's done this well. But there's one more thing, real quick.
Yes.
Gold typically suffers when the market fears interest rate hikes. This isn't just
Yes.
some skirmish in East Africa or something. This war is in the bloody Middle East, and the impact on oil and the presumed impact on inflation from that is obvious. And so I think this is why we've seen the wiggles on the daily markets. Scary news from the Middle East, gold down. Peaceful news from the Middle East, gold up. And that's entirely tied, I think, to the inflation expectations and that old saw about gold doesn't pay interest, right?
Yeah.
So nobody should be surprised by this.
That's the clearest explanation I've heard in a long time. Yeah, thank you.
Okay.
Gold's inverse relationship with interest rates. I think
Interest rate expectations.
interest rate expectations, and actually, if you chart this rather with the 10-year yield, U.S. 10-year. What am I doing here? U.S. 10. Here we go. 10Y. This you'll see a almost perfect inverse correlation ever since March.
Right. Well, why is anybody surprised by this? Just one more thing, real quick. This is, of course, a mistake. To me, the most clear example of this was the rate hiking cycle 20 years ago or 20 plus years ago, where, gold went down when people thought the Fed was going to raise rate. But when the Fed actually started raising rates, gold and the rates went up together.
Mm-hmm.
Because the reason for the raising of the rates, can coincide with gold. Anyway, so yeah, I think the market is making a series of mistakes here. And the only reason why or the main reason why I'm not in a rush to take advantage of these mistakes in this space is because the market can keep making the mistakes. I don't know how to time the bottom here. That's why I'm patient. I'm holding on to my cash.
Sure.
But I think the market's making a mistake. I think everything that we've just discussed is very bullish for gold, and that we will see that in due course. I just don't know when that'll be.
Okay, I want to point to copper now, something that you've liked. I wonder if you still like it. And you'll notice something remarkable, which is that copper has traded very closely with gold all throughout last year, all throughout the first quarter of this year. And then around mid-April, complete divergence. Why?
Well, a couple of things. We had a lot of divergence in 2025. And by the way, the
Mm-hmm.
correlation between gold and copper over longer term is something like 90.9. Like it's it's very high. And that
Yeah.
argues for the commodity super cycle. and anything real, as I say, not just monetary metals,
Hmm.
responding inversely to inflation, or it's, the prices of real things go. But in 2025, we had, major volatility in copper space due to tweets, the tariffs, the front running of the tariffs, and then the tariffs weren't what we thought they were going to be. So that's some of the ungluing there. As far as, this year goes, if you had gold and silver get ahead of themselves and now correcting back, and maybe healthy correction back towards something more sustainable, maybe that's a good thing. But copper hadn't gone, nuts. So yes, it touched a nominal all-time high, but nothing like those parabolic moves that we saw in gold and silver. So the divergence again doesn't surprise me. If we look back on this in 10 years, I think we'll see that the divergences go away. But to answer your question, do I like copper here? I like it a lot. I just, it's hard for me to call it a buy low opportunity when it's kissing distance of all-time highs, even
Yeah.
just nominally. But I'm going to mix commodities here with a little bit, but I have something that is hopefully a useful takeaway for the audience here. The war in the Middle East, if it continues, is very bearish for Dr. Copper, right? The demand destruction that everybody assumes will come, and not unreasonably, that does happen. The economic knock-on effects of higher oil, the places where, unlike the US or Canada, where they have, at least theoretically, a surplus of oil, right? There's places where you just don't have it. And that immediately has economic impact and fallout. So that, if it continues, should translate to lower copper prices. So as much as I like copper, and I'm very bullish for years, if not decades going forward, the odds seem to suggest that as long as things are the way they are now, we'll get a lower entry point. Now, there's a pair trade here. If I'm wrong about that, that's not the way it goes. Let's say the war ends, or is declared to be ended. We should see oil get knocked down. Oil's been up because of the war, reasonably, right? You close the Strait of Hormuz, oil's up close to $100 a barrel, no surprise. And we've seen oil drop 20% just on a tweet, on a peaceful sounding tweet. Now, what happens if they actually announce a peace deal? Well, I think we're going to see oil go much lower. Now, if that happens, copper would go higher. Peace would be good for copper, but bad for oil where it is now. But if we don't get peace, we get continuing hostilities. That's bullish for oil prices, but bad for copper. So what I'm saying is that we have an either or scenario here. The beauty is, like, I don't know which one of these cases will be, but there's only two options. The war either continues or it stops.
Yeah.
If it continues, I think we get a buying opportunity in copper. If it stops, I think we get a buying opportunity in oil, and both are essential critical minerals.
What if copper is moving independently of the war in the Middle East? What if it's moving mostly because of AI capex build out that's happening worldwide? Even in Vancouver, I was just reading, starting this year, Vancouver is partnering with TELUS, a local telecommunications company, to build AI data centers, converting offices. And so I wonder, even in your scenario where, let's say, the war ends, if the war continues, which you say would cause demand construction, maybe it will cause demand construction in other areas outside of AI. What do you think?
Yeah, I hear you, but I don't think that squares with the inventories up. We actually have
Okay.
high copper inventories. I think the 800-pound gorilla in the room right now is still front-running tariffs, fear of
Hmm.
tariffs. There's a refinement in the copper tariff that the White House is supposed to be working on, and we don't know exactly what that's going to be like, what final products will be covered or not, what countries will get carve-outs or not. So I think that has a lot to do with where things are right now. But you know what? At the end of the day, even if you're right, even if this is a factor, this is all short-term volatility. The bigger picture is, we just haven't made enough copper discoveries. Like everybody's all excited about the Filo discovery, the Lundins down there in South America, in Argentina. It's a fantastic discovery, but that's like the biggest discovery in the last 10 years. We need like several of those every year to cover anywhere near the copper demand that not just me, But all the big engineering firms, the Wood Mackenzie's of the world and so on, and the banks involved in the resource sector are projecting these massive deficits. We're just not discovering enough copper. So that's the real bull case here, not the AI now or whatever may or may not happen with the war. And so, this puts me back in the situation of I'm sitting on a pile of cash. I don't know what's going to happen here. I don't know if the AI bubble pops and it sends copper crashing down. That could happen. All I had to know is that I've got the cash to take advantage of it if it does. And if it doesn't, there'll be something else. I think probably it'll be oil, but it might be, who knows? It could be uranium on another DeepSeek type scare.
Yeah, let's talk about uranium now. Good segue. Is that the future of baseload energy? Are you betting on that?
Absolutely. I think I'm not the first or only one to say this. Smarter people than me are pointing out that if there's any takeaway from this new war in the Middle East, it's the essential role that nuclear power has to play. Our mutual friend Rick Rule likes to point out that a country like Japan, a major industrialized nation, can store 5 years worth of energy in a single warehouse. If you go nuclear, you physically cannot store that much oil or coal or anything else to supply that much energy. And if COVID was a wake-up call, and if Russia's invasion of Ukraine was another wake-up call that, gee, energy independence is kind of important, well, this war in the Middle East and the closure of Strait of Hormuz, that's not a wake-up call. That's an ice plunge. Like it is impossible to sleep through this thing right now. How many wake-up calls do you need? How many ice plunges do you need before you get the memo and say, you know what? Some real dependable 24/7, 365 energy dense independent power supply would be a good thing. So I think this is a paradigm shift, meaning it is a one-way change. There is no going back from this realization. I do believe it would take a Chernobyl scale event to potentially derail or even just slow this down.
Well, Lobo, the uranium price at current levels, is that enough to incentivize miners in North America to ramp up production?
Yes.
Okay.
So if you say the uranium price, so the spot price is one thing, the long-term contract price is another. The latest read we have on long-term contract is 94 or 95 bucks a pound. That is enough. And, even a couple of years ago when it hit triple digits, we could see that the incentives were kicking in. And I think there was a legitimate concern that high prices would cure high prices. In January of 2024, I again made myself unpopular at Vancouver, saying that the uranium at triple digits, maybe some correction was in order. But the answer to your question is yes, and we saw a whole bunch of mine builds, mine refurbishments, ramp ups or attempts. But since then, we've seen that none of these have been on schedule. Some of them haven't even gone forward at all. The money hasn't been there, or the ramp up is taking longer than expected, or it cost more than expected. Like the reality has turned out that the low hanging fruit that was going to cure high prices was quite prickly, and the high prices haven't been cured yet. So I'm extremely bullish. My only problem with uranium is that this story is so obvious. I mean, this isn't just a resource commodity nerdly case here that everybody's talking about it. It's become an AI story as well, to your point about copper, right? So the mainstream gets it. When you have Meta and Oracle and Google talking about building SMRs, right? The mainstream is waking up to this story. And why I say that's bad, for the long term is not bad. But for me as a buyer, as a person who'd like to have more uranium in my portfolio, though that's just about all I have left after my recent sales, I'd be happy to have more because I have high confidence of a higher price in the future. But the stocks haven't really gone on sale. So, if I didn't have any uranium stocks in my portfolio, I wouldn't wait. I would get some of the best right now. But since I do, and I own, I think, the best of the best already, I am looking for another fluctuation, something like the DeepSeek moment just over a year ago, to give me a shot at silly cheap prices.
Of all the commodities we discussed so far, which are you most bullish on?
Depends on the time frame. More immediately bullish, it would have to be uranium.
Okay.
Like the rest of this year, uranium it's just been stair stepping up without stop. The real price, that is the long-term contract price. If you give it a longer term outlook, probably copper. Even without the AI or the electric cars, it's Dr. Copper. It's absolutely essential, and the discoveries aren't there. And unlike uranium, there's no copper reactor that can melt down and scare everybody out of the market. So longer term, copper is a no-brainer to me. Now, where does that leave gold and silver? I like them a lot. I think that ultimately, we're going to see easily, ultimately, triple digit silver becomes normal, like gold in 5 digits. We're at 4, so we go to 10K plus, we're looking at 5 digits. I actually do believe that's coming. But as we were discussing earlier in this interview, I'm not sure that we won't see a 50% drawdown before we go off to that. Like the fundamentals, I think most angry gold bugs who are ready to throw rotten tomatoes at me now for saying these things, I actually agree with them about where we're going. The disagreement, and I'm not even predicting that it will drop 50%. I'm just saying that there's enough risk that January of this year was like September of 2011. There's risk of that, not certainty, but enough risk of that I don't want to take the chance of writing that, down. Maybe if I was a private investor with nobody looking over my shoulder, I could do that. But as a public figure with 50,000 very best friends looking over my shoulder and saying, "What have you done for me lately?" I can't tell everybody not to worry about gold because 10 years from now, it'll be over 10K. Not if it goes down for the next 2 or 3 years. That would be, people would realize unnecessary losses if I did that. So the responsible thing for me to do is not predict, but warn of near-term downside in gold and silver.
People can follow your work to learn more about your take on miners. Where can we go for that?
IndependentSpeculator.com. The easy ask here is I have a free weekly newsletter. You may not agree with everything I'm saying. You may want to get your rotten tomatoes out to throw at me, but the one thing I can guarantee is that we won't spam you with a flood of advertisements. You get one notification per week. And then decide whether or not I'm rational enough to maybe help you out with some due diligence, which is what I really specialize in.
Okay, good. I'll put the link down below so you can follow Lobo in the links in the description. So please check him out. And he's got a great X account as well. Thank you very much, Lobo. We'll speak again soon. Take care for now.
Look forward to it.
Thank you for watching. Don't forget to subscribe and like this video.